I heard Melanin Money is one of those mastermind programs, right?
Like online coaching? Nah. I think they podcasters, bro.
You mean like online gurus? Nah, bro, they do events. That's what it is.
Like party promoters? Nah, I know what it is. I think they got their own fashion brand. You seen the drip kind of crazy.
Like designers?
Yeah, man, some
No,
Giorgio Armani type of vibe.
no way, bro. No way. We get it, y'all. We do a lot, and we hear the noise.
We understand we're not your average financial experts, so there might be a little things that got lost in translation. Allow us a moment to clear it up.
My name is Carter Cofield, and I was named one of the top CPAs in the country.
And my name is George Achenpong, and I've been one of the top 100 advisors in the nation several years running. And together we founded
Allow me to reintroduce myself. My name is Ho.
And over the past few years, we've helped our clients improve their collective net worth by hundreds of millions of dollars. And you might be wondering how we did it.
Well, it's because we don't just sell secrets, we actually provide the services.
We don't just teach education, we actually help with the execution.
We don't just give information, we actually help you with the implementation. So if you're done buying courses and you want to get access to the sources,
You want to work with real experts to build real wealth in real time because you know that you're worthy of wealth? Check us out.
see you on the other side of wealth.
Welcome in to day 2 of the Wealth Workshop. How you doing, brother? Looking like Carlton, Fresh Prince over there.
Don't ever play yourself. This is what you call old money, my friend. Don't ever play yourself. How you doing?
That's the money you can't see. That's the money you can't see.
Big facts. Now I'm doing well. So me and Carter, spoiler alert, we actually had a coin flip today, right? So, it's 5 days. 5 is an uneven number. And you know me, I'm the crock pot guy. I said, I want my own days. And so we said, well, how are we going to figure out that odd day? How are we going to figure out who gets, so we flipped the coin. We bet everything. If y'all didn't know, we would bet if the sky is going to be purple tomorrow, right? We bet everything, but we flipped the coin and ultimately we couldn't decide who was going to get that third day. So we are splitting the day today. Spoiler alert.
That
way we both have 2 days and then we split the day. Yeah.
half and a half.
Yeah, I was like, this guy.
That's what the people would want, man. That's what the people would want.
Disrupted my plan, but I just wanted to get that out the way. But other than that, I'm feeling great. Today's an amazing day. How are y'all feeling after day 1?
Yeah, who didn't get much sleep last night because their head was still spinning. Now I saw some of y'all in school at like midnight. Yeah, there you go, Angela. I see you. Yeah. So I was going through school like, yo, like these people ain't sleeping, but we should have gave y'all that warning ahead of time. Should have gave y'all that warning ahead of time that some of y'all not gonna get no sleep tonight. But I think more than anything, what makes me and George so happy and proud to do this is to like see the real life transformation that people are having throughout these days. I was reviewing school. The other day, this morning, and I want to highlight these two, right? So Marva Butler said, today's first session was pure fire. My mental downloads, parent company S Corp says operations and employees. The other LLCs generate income through the S Corp, get filed under the parent company, and only one tax return. Active income is used to buy passive income, real estate, self-directed IRA, solo 401k, life insurance. Utilizing these proper strategies, I can be my own bank and loan myself. These are truly actionable items working in my favor, right? That really made me happy just to see the transformation from one person on day 1, right? Day 1. And this is somebody else I want to highlight. And I want to highlight this because I feel like a lot of you all may feel like this way, but like maybe not communicate it, right? And so Jennifer said, I am wrestling with the feeling of guilt that I'm not further ahead in life. Life circumstances has thrown a few curveballs. But being the primary breadwinner, my plate is full, but I absolutely will not give up. As discussed tonight, I am the one who will turn things around for my family. It might take me longer, but I'm gonna keep moving forward, right? And that's the thing, y'all, like, don't feel guilty. You just didn't know this, but you're in the room now, so you're already on a better track than you were previously. So anybody feeling that guilt, let that guilt go. Right? Let it go.
Let it go.
We are here.
Sometimes you gotta let it go.
Yeah, let it go. We are here, and we're gonna learn, but you can't pick up new bags if you're holding on to dead weight, right? So you gotta let that guilt go.
That is a fact.
Yeah. Well, with that being said, I promise y'all we ain't gonna sit no more of y'all Q&A time like we did yesterday. So we can get right into Q&A and get this thing rocking and rolling. Stella,
Hello,
how you doing?
I'm doing
Hello.
well. Hi, I'm Stella. Um, so a few questions. I'm a W-2 earner, and my apologies if I'm asking a question I was already asked. I was there for the first hour of the lecture yesterday. I had to work from 7 p.m. So I'm a W-2 earner. Um, but I picked up a second job that will be a 1099. That'll probably make around between 30 and $50,000 a year. So how would I'll say maximize my tax benefits or pay less in taxes? Because this year we paid almost 40 grand in taxes. I paid without without any returns at all. So how can I, with this 1099 job, get some tax benefits or write-offs?
Yeah, great question. So you have a W-2 job full time. It sounds like you're making
Yeah,
money there because you had a $40,000 tax bill and you're about to bring on this other source of income, which is 1099, another $30,000 to $50,000 in income from the 1099. How do you like
yeah.
bring on that extra income without bringing on a larger tax bill, right? So
Right. Yes.
great question. And this is a scenario we love people and we love either one spouse having a full-time job, the other spouse being a business owner, or one person having a full-time job, but also having a side hustle that's 1099. Because now you get the best of both worlds. Now you get the stability of a W-2 job, but you get the tax benefits of a business by being a 1099 contractor, right? So what
Mhm.
we recommend is that you maximize the deductions that you get in the 1099 company. So let's say you make 50,000 in a 1099 business. We can easily find 60, 70, $80,000 of deductions, depending on what the situation is in that 1099 business, right? Because now most of our personal expenses we can now write off in that 1099. So let's say we got $50,000 of income, but we find $75,000 worth of write-offs, right? That means you're going to lose money in your 1099 business, right? About like 25,000,
Right.
right? And then that
Mhm.
$25,000 loss from the 1099 business will get subtracted
Oh,
from your income in your W-2, which will lower
okay.
the taxable income from your W-2, which will mean they either can take less money out or you'll get some money back. So the question is, what can I do to maximize the deductions in the 1099 business so that I can have enough deductions to offset income in my W-2? And that's why we're here, like to learn how to maximize the deduction. But that's what you will want to do. That's the what. Now it's like how, what deductions? Is it vehicles? Is it real estate? Is it your home office? Is it children? Is it so then you have to implement these strategies to be able to offset that.
Okay. And that can be done. I'm a healthcare, let's say I'm in nursing, a nurse practitioner. I'm able to do that as a 1099, write off all these things that you're talking about, the home office, the using your children, as
What
staff.
it all can be done through strategy, but it all depends on what the business is and how can we make these expenses legitimately ordinary and necessary for you to operate that business, right? We want
Right.
it's legitimate. So
Okay.
that's what the strategy is for.
Okay.
Great question. Great question. I'm about to give me a liquid death, George. Go
That
ahead.
inspire you?
Yes. So I was like, how did I not bring one to my desk? Well, how you answer this next one, regardless of what it is. Is it Shanae?
Hi, it's Shanae.
Yes.
It looks like you're driving, so we don't
I am.
we don't want you
Yeah,
to look at us. Look at the road. We can hear you.
don't worry, I'm not. Okay, thank you so much for taking my call. My name is Shanae Clark. My question is, I am a W-2 earner. I'm a registered nurse and I'm also a cook. I'm Jamaican and I make authentic Jamaican dishes. I have been selling them to my coworkers who have requested it since I made holiday for them last year. And I now feel like I was so stupid. I should have made an LLC way before, so that I could have been maximizing on this like business. But because it was just kind of localized to my staff and the other people that I supervise, until it like it's growing more and more. And I want to know if, even though I didn't have my LLC made yet, can I still structure myself in a certain way so that I don't lose off of this year. I'm in the process of getting my LLC. I think it said 3 days for it to be vetted for my state, Virginia, before they can I get all the stuff. So I want to find out if I'm still able to take advantage of these business stuff, since I kind of missed out on, since I already started and I didn't have my LLC formed before I started.
Yeah, so as I mentioned yesterday, establish your LLC does nothing for your tax deduction. So whether you didn't have an LLC, or whether you do have an LLC, your tax deductions will be the same, right?
Okay.
So you still can write off all those expenses that you incurred. You didn't have your LLC, and that's fine. I mean, like the LLC is for asset protection, not tax savings. So to answer your question is yes, you can still take all those deductions that was ordinary necessary for you to make that income.
Okay. And I went today to payroll and I shifted my withholdings to make sure that I get like next year, because I got taxed this year and I don't want to have to happen again. So I followed your advice last night. I didn't go to bed until like after close to 1 o'clock. I was up watching all your YouTube videos and my mind was just going, girl. As an immigrant, I was like, I can't believe I've been here playing the fool all this time. I could have been, yeah. So, but
Well,
thank you.
when you know better, you do better. And that's why we're here. When you know better, you do
Right.
better. So forgive yourself and stay locked in.
Absolutely. You don't have to ask me twice. I'm here driving and I'm doing this. Let's go.
Let's go. Let's go. All right, I'm gonna grab me a liquid death. I'll be right back.
All right, Carla.
Hello. Um, my name is Carla Hooks, and I have like three questions I want to ask.
Okay, let's start with your most important one, because one of the things we tried to, because we have a lot of questions to get to, we try to stick to one at a time, unless we can kind of, unless there's a way to kind of string them all together, and then of course we'll spin the block and answer the other ones. But if you can start with your most important one, unless you think that you can somehow package it all together, we'll go from there.
Okay. Okay, I guess
Cool.
this one. So if I'm a 1099 earner and the company that I work for, they have an office for me to use,
Mm-hmm.
do I have to start whenever I go on appointments? Does the mileage start from their office or does it start from my home office? Because I've been told that I had to do it from their office. So, and I've also had my own business as well. So, what's the difference? I mean,
This is a great
where
question.
do I start the mileage recording?
Get back. This is a great question. So I love this question so much. I'm trying not to take a lot of time answering it. So the question is, if you have a business or 1099 contractor, and you have an office that you have to go to in your 1099 contracting job, does the mileage start when you leave the house, or does the mileage start when you leave the office? Right? So the mileage starts when the commute from your house to the office does not count towards mileage. If you have to leave the commute from your home to the office does not count towards mileage. But if you have to leave the office and go see a client, go to another site, do something else, that counts as mileage. But to the office and from the office does not count as mileage. Unless everybody drop unless in the chat, because when there's a will, there's a way. Unless you have a home office.
Mm-hmm.
Because if you have a home office, me and George, we're both teaching this class from a home office, right? We could have got a space that we work, but we want to have a home office. Why? because I technically stopped at my home office before I left the house. So if I have a home office, now the mileage does start from my home office to the employer and everything in between, and then on my way back home. So one of the benefits of having a home office, taking advantage of the home office deduction, is that that is technically the first stop. So if you have a home office, then it starts from your home office. If you don't, then it starts from the job site. Does that make sense? That's why people are giving you mixed advice.
I understand that what you're saying.
I think she's frozen.
It's okay. I do have a home office. And so it was my understanding, because I have my own office, I can start my mileage from my home office with as being so like not consider myself self-employed, even though I had a home office, because I worked for that company. So that was,
Well, yeah.
just
So if you,
to make sure I'm clear.
you cut out. I know the internet's kind of bad, but what I heard is because you're technically employed, even though you're a 1099 contractor, you didn't know that you could do that. But if you're a 1099 contractor to the IRS, you are self-employed. Like your employer does not pay payroll taxes for the money they pay you, meaning they do not own. If they're not willing to pay that ownership of, then they don't own your time, right? You are self-employed. So even though you have a 1099, and even though you go to an office and you're technically have an employer, you're still self-employed. So that means you take advantage of the home office deduction. And if you do so, that commute is to the main office is still part of your business commute. Hope that makes sense. Her internet was tricky.
Lisa.
Hi, thank you. This has really been amazing. I am Lisa Anders and from Washington, D.C., and I do have a couple of questions, but I will go with the first one. Yesterday, in the example or the information you were sharing about the LLCs connected to the parent company, what started first? Did the LLC first start and then it becomes the parent company because then you open other businesses? And then once you did that, you mentioned the parent company has the operations, which is different than the holding company. So what are the operations of that parent company when you have multiple LLCs?
Great question. So let's say you start off with one LLC because you expect to have one business, right?
Yeah.
And then you decide that you want to have, and let's say you make that LLC a S corp, right? Because it's already making a lot of money, because we don't want to start the second business into what our first business already makes.
Right.
So you have LLC taxed as an S corp. Let's say that's making $300,000, but now you want to set up multiple businesses. You're like, I want two more businesses, whatever. You have two choices. You can convert that S corp that you already have into the parent company, or you can set up a new LLC that needs to be S corp that will be the parent company. But that would mean that you have to remove you have to revoke the S election on the first company, because we don't want to have two S corps.
Right.
So we have to revoke the S election on that first company, which is just saying, hey, I no longer want this company to be an S corp, right? Cool. And then we set up that parent company and we say, hey, this parent company is going to be the owner of that LLC. So we need to change the operating agreement of the original LLC we had. So now we have a parent company, and now we have that same S corp that we always had. We just made it LLC from here on out.
And that parent company, you mentioned the difference between that and the holding company is that the parent company has operations. What do you mean if it's kind of the parent?
Yeah, so the parent company can't have operations. So what our parent company does is it pays our employees. So all of our employees are in the parent company. They're paid under
Okay.
right? So it has operational of making sure all the employees get paid, right? The other subsidiaries doesn't have employees. All of our employees are under the parent company. Now, if we didn't do that, then it could be a holding company, but it did have, that's the operations that it had. In our situation, that's the operations that it had.
So like marketing, some kind of common commonalities between them. Okay. And then does it matter what state that you set up an LLC, or should it generally be your home state?
LLC should always be set up in your home state unless it's a holding LLC for real estate. Then it can be in Wyoming or Delaware. But the biggest misconception that most people have is most people think that, oh, I live in California, but I have an online business. All I do is sell courses. So I'm gonna just incorporate in Nevada. No, that is illegal because it either has to be the state that you do business in or the state that's your home state. So if you have an operational entity, you have to have that business set up in the state that you do business in. If not, that's legal. So only time you can have a company set up in Wyoming or Delaware that you often hear advertised on the internet is if its sole job is holding real estate, which is fine. Hope that answered her question. I know a lot of y'all had that question. I know a lot of y'all had it.
Hi
Robbie,
guys. Hi guys, can you hear me?
we can hear you.
Hey, hi. It is one of the great decision in my life, I believe. Thank you so much. I could attend this session. I have a couple of questions, but both are related, George. So I do have two LLCs, and I'm a high-paid W-2 employee in solution architect space in the supply chain management area. So my question is, I could not utilize some of the opportunities. Like one, I do have a home office, and it's my primary home. I have my mortgage. So how do I utilize 30 to 40% of? I think Carter, you were mentioning that 30 to 40% of my mortgage or rent can be utilized as a reduction, right? That is one, and um, help me out, which is more important. Other one is about my car. I could utilize most of my car expenses, but car loan I could not. So how do I, both of them being kind of paid from my W-2 income, and whereas that vehicle and house, how do I tag to my LLC and say I can take a deduction?
I'm trying to make sure I understand the facts of the question. So I know you have a high-paying W-2 job, and then you say you have two businesses on the side. Of that, did I hear that correctly?
That's correct, Carter.
Okay. Do these businesses generate income?
Yes.
Okay.
One is S corp. One is S corp already.
What is it?
One of the two business is S corp.
Oh, okay. S corp. So you got a W-2 job, an S corp, and an LLC. You cooking with grease. Then the question is, can you deduct your home and can you deduct your vehicle?
How do I do it? Because my W-2 is where I'm using to pay some of the loan and for vehicle loan, and home is a primary home which I'm paying the mortgage.
Yeah, so it's just a matter of, so I think I get to understand now. How you pay these bills is semi-irrelevant to writing them off, right? So if for the vehicle, if you pay your vehicle out of your personal account all year, you just need to, at the end of the year, add that deductibility amount to your profit and loss statement at the end of the year, right? So if the car note is not deductible. Interest on your car note is deductible. Let's say you pay $10,000 in interest, right? But you paid it out of your personal account when you paid the note. You just add that $10,000 back to your profit and loss statement as interest expense, right? Same thing for the home office. You would just be like, oh, okay, cool. My home office was $800 a month, 12 months, $9,000, whatever. Add back to your profit and loss statement as home office expense or rent expense. I don't put home office expenses, red flag, rent expense. But that's it. It just doesn't matter what account is paid. You just have, if it's not connected to your QuickBooks, you just have to have your CPA backdated and add it back so they don't miss it.
Got it. Thank you, Carter. That's helpful.
Easy money, man. You sound like you had a major situation, brother. Like keep it going. A full-time job, an S corp, and an LLC. My brother is working.
So he's getting all the coins.
Yes, getting all of the coins.
Natasha.
Yes, good evening. And thank you for yesterday. Yesterday really had me going. Like my mind like exploded. Like I was up late just researching. And I think somebody already asked kind of part of my question, which was the parent business. But so I just wanted to clarify. So in order for you to have a parent business, you have to at least have more than one business, correct?
Yeah, let's not make things more complicated than they need to be. Because
Okay.
Me and George are on a whole tangent. Please, please.
Okay. All right. I just wanted to make sure about that. And as in the business that I have, it's really like I've been doing 1099 for it, right? And it's for like insurance, like health insurance and life. So with that, as a regular agent, you have to have like the E&O insurance, errors and
Mhm.
omission. So if you make that a liability, if I make that a LLC, right, which is for asset protection, would I have to, do I still have to have both the E&O, which is also kind of like protection, and also, if I was to go the LLC route?
Well, as a licensed professional, you're gonna have to have E&O insurance regardless.
Okay,
The LLC is just overall separation and protection from you as the individual
okay,
versus the business, right? But you're still gonna need to have that errors and omission coverage as the licensed professional.
okay.
Yeah,
All right, that was my question. Thank you.
you're welcome. We encourage y'all to have those insurances because the deeper you get into business, you might get sued, even if you weren't necessarily in the wrong. And better to have that insurance and have that cover it versus you having to settle and pay a lot of money. So, Miss Irish,
Hi,
hello, how are you?
I am well. How are you all?
If we were any better, we'd be you. So, I think we're doing all
So
right.
I want to reiterate what everybody else says. I mean, mind blown, all that good stuff. I have a clarification. It's not my question. So if you are a 1099 employee, you consider that the 1099 business. So we can look at that tax form download and use that as our guideline for being a 1099 employee, right? Did I get that right?
Can you ask the second question and then I'll
Okay. All right. And then, so one of the things you said was that active income is used to use it to build passive income. Technically, home equity is not active, but should I use my home equity money to then build into some of these passive things that you talked about? And from that, um, use also my equity to trademark my business. Now, do you suggest trademarking a business? Is it easy to DIY it, or do you suggest hiring out?
Okay, so let's start with the equity question. So when Carter mentioned using your active income to build your passive income streams, because most people, unless you are retired, you're going to have some type of active income, right? And then we want to prioritize taking some of that active income to start building our base for our passive income so that we can become work optional. Now, if you have an asset already that is appreciating in value and it is technically not active, but you want to leverage that passive income to acquire more assets or to build more wealth, 100%. That's a part of what I
Okay.
consider to be the financial freedom flywheel. So those two things are mutually exclusive. We're just saying that if somebody is actively working, they most certainly want to be taking a percentage of that to start building their passive wealth. But if you already have someone that working on your behalf and you have equity that is appreciated, most certainly leveraging that to build more wealth makes sense. Now the trademark question, I'll answer that really quickly. Definitely hire a professional, my opinion. I think we might even have some attorneys in the room. But yeah, definitely if you need a trademark for your business, definitely hire a professional for that. But again, don't ask me because I'm the delegation king. I only focus on what I'm great at. But I wouldn't do it if I were you. We have like 11 pending trademarks right now. So yeah. Hopefully that answers your question. I know they took you off a little bit early, so so hopefully that answers your question. All
What's going on,
right.
guys?
What's going on?
How you doing? My name is Nanakwame Darko from New York, and my question is, in terms of payroll for S corps, um, there's a lot of nuances with it, whether taking 25%, 50%, 60%, whatever the case may be. Is that going to be taught in this course, or are we going to have to seek that information outside? I did take a look at Carter's the PDF, and I went into Gusto, went into a rabbit hole with that, and and stayed up till 2 a.m. So I want to know if there's something that will be covered or if that's something I'll have to seek outside.
Um,
Thank you.
my brother, since you stayed up at 2 a.m., I would feel irresponsible not giving you the answer to that question. That I could have gave you back a couple hours yesterday. So yeah, let me I'm looking for something as we speak so I can pull it up. I just made a video on it. Here we go. Okay, so one of our tax mentors created this thing called the Kohler payroll matrix. And this is probably the best way I've ever seen it explained on payroll, right? So when you're an S corp, right? S corp, it starts to make sense at $50,000 in net income. So this is net income at the bottom. So the less money you make, the more percentage of your net income you need to pay yourself for it to be qualified as reasonable. So when you start out, like, you start out as an S corp making 50, if you have $50,000 net income, well, since you don't make a lot of money, your payroll needs to be 50% of the net income of your business. But when you make more money, so let's say you have $100,000 net income, you can do a payroll closer to 40%, right? And then $200,000 of payroll, you can do a payroll closer to 35%. And the more money you make, the lower your payroll percentage has to be for it to be deemed reasonable. And what I love about this matrix is once you start paying yourself a salary of $100,000, you don't have to increase it anymore. Like $100,000, we all can agree that $100,000 salary is reasonable for almost any role in the business, right? So once you start making 400,000, 500,000, a million, you don't have to pay yourself a salary of $250,000. You can keep your salary at 100,000. So this is like the best way I've seen it explained on payroll and different salaries. But the thing I want you to know is the more you make, the lower percentage you can go for it to be deemed reasonable. I'm gonna let you come off mute. Did that answer your question?
It did a lot. Thank you so much.
And I'm gonna copy this and put it in the chat for anybody who needs it.
Appreciate it.
Hello, gentlemen. Again, like
Hello.
everyone else, thank you so much for all that you do. Greatly appreciate you taking the time to work with us. And I love seeing Michael Kohler's display there. I've worked with him with real estate groups. So great to see that. My question relates to real estate, and I'm looking at the best way to structure a business to reduce liability or to structure those companies. I know last night you talked about setting up different LLCs. So my question is, should each property be an LLC? I've heard pros and cons of that. So I'm interested to hear what you have to say.
I actually don't know if me and George think the same way about this.
You say you don't know if you think the same way about this?
Yeah, I do. What is? I mean, 'cause we actually never talked about it like that. Do you?
Yeah. I mean, I think we haven't, so I guess we can see. Yeah, we
Okay.
can see if we have the same philosophy on it.
And does it matter the number of business of properties? So if you have 10 properties, well, in my
Yeah.
case right now, 4.
You said 4 properties right now? Yeah.
Right now, yeah. Should they be separate LLCs or they're currently in my
Yeah.
name and my brother's name?
I mean, if you talk to an attorney from a liability standpoint, they're probably going to say yes, right? And they're not wrong in that estimation. But I would like to think about it in terms of like the total equity value of the properties, right? So, for example, if you have 3 properties, but the equity is not in excess of $1 million, right? Maybe that's the threshold. So picking a reasonable threshold for the total equity of the LLC versus the individual property itself would be kind of the thought process and the rationale that I would go about versus because it could get a little bit cumbersome, right? Especially if you're buying single family. Now, if you're buying multifamily, okay, cool. Like that,
No
we're
single
counting that
family
as
right
a
now.
property, right? 3, 4 doors, cool. But if you're doing single family, that can become cumbersome to just have an LLC for every single one. An attorney will probably tell you to do so. And I'm not an attorney, so Kanye mean, right? So I'm not telling you not to do it. But what I am saying is I would look at it more from the total equity value of
So if it's
the
over $1 million,
yes. If it's over $1 million, then let's transition to having another LLC.
each one in an LLC?
Well, if the equity is over $1 million,
If the equity value is over $1 million.
fine.
Okay.
And the reason I brought that up, George, is I'm like, I'm like Mr. Oversimplification. So I'm like, yeah, just kind of put them all like, but no, I think that's a great way to put it because it's not about the amount of property, it's about the equity, because that's what you're trying to risk mitigate, right? You're trying to mitigate the risk of losing the equity in the property. So I love the way George put it. It's not about the necessarily whether it's 3 properties in LLC, 5 or 7. It's once that equity gets to $1 million, you need to start a new one. And it's the nuance is worth it because you're like, I just protected $1 million. Like I can live with the other paperwork and the renewals and the books and stuff like that. But then there is an option. It's not every state that allows you to do this. You can set up a series LLC.
Series LLC, yeah.
It's only 9 states that allow you to do that. And Illinois, I know is one of them, but you can just Google which 9 states have a series LLC and you get the best of both worlds. But other 41 don't.
Naisha, did I say that correctly?
Yes, hi, thank you. Okay, I'm gonna try to roll my 2 questions into one.
There we go.
am I'm trying.
I believe in you.
Yes. So I'm trying to decide whether or not I should sell a property or borrow against either properties or my equities. So I don't have active income anymore very recently. And I'm not sure when I'm going to, but I do have significant assets. But I want to grow my assets and I want to have some passive income. I have 3 real estate property, rental properties,
Right.
plus equities, plus a coaching business, but I'm not doing that right now. And so I'm trying to figure out, for now, I heard you talk about borrowing against your portfolio to buy other assets to create cash flow. And so I'm trying to understand, like, what would be the best assets to do that, where you cash flow immediately if you don't have active income to pay back the minimum payments and also not get over leveraged. All right, I'm gonna stop there.
No, that's that. I mean, listen, that was packaged well. Okay. So
question.
The first thing we always want to start with is what is the goal, right? So it sounds like the goal is I'm not currently receiving active income. So naturally generating income is going to be of paramount to me.
Yes.
I have assets currently. So the question becomes, what is the best strategy to generate that passive income? Because if I sell a property, well, now I'm losing an asset from my portfolio, but then I'm getting the cash that I need to potentially buy another investment that could mitigate the amount of borrowed capital that I need, because I'm not currently receiving active income. So I want to make sure that I'm keeping that in mind. Is that a fair assessment?
That's a fair assessment. And selling, I have a lot of equity in each one, but there's a lot of potential capital gains tax that I'm trying to avoid.
Exactly. Right. Exactly. So it's always, 2 things I always say. Number 1 is, what is the goal? And number 2 is, what does the math say? Right. The one thing I love about personal finance is, it's very, to a degree, there's a qualitative element, but it can be very binary, meaning like, what does the math say? Right. So to your point, I'm a big fan of, to the best of my ability, if the asset still makes sense to own, I want to keep that asset, right? For a variety of reasons. And so if I do the math and I say, okay, this next asset that I want to buy, right, I'm going to need X amount of dollars. I look at the equity that I have. Okay, I can borrow, assuming the terms are favorable, I can borrow against the asset, right? Get the money to then acquire the other asset. But I wouldn't know if it makes sense before I ever borrow it, right? I would know that the down payment or the money that I'm getting for the cash flow producing asset, I would know how much cash flow I'm expecting from that, and then what is the net difference between the me servicing the loan interest or the payment that I would owe and the difference of the cash flow. That is going to determine if it's a good decision or not, right? So that's just a math exercise that we can do. Now, the question is that more real estate? Maybe, right? Or is it acquiring a business, right, that you could own but not run? Also, maybe, right? All depends upon your risk tolerance. All depends upon what you want to focus on. The good news is I'll be touching on a little bit of that on Friday. Is it Friday? Is it Friday? Yeah, Friday. But ultimately, in advance of that, just to give you the strategy or the perspective is, let me do the math based upon what I would be considering investing in. I can't tell you which asset class is going to make the most sense, but I can tell you that when you decide, or I can give you a range of different options, and once you decide, then you can determine if the net cash flow minus the debt service, would it make sense to still make that investment? Because that's ultimately what you're after. Because most people are afraid of borrowing money because they don't know that answer. They haven't done the math proactively to determine, oh, I borrow 100,000. I'm able to buy this asset. This asset's going to spit out this cash flow. I'm going to owe this amount per month. I'm still going to net out $3,500 in cash. Like, they don't know that. And so that's where the lack of confidence comes from. So once we know what investment we would acquire, then we can back into those numbers, and that will determine what option makes the most sense.
Okay. Okay.
Okay.
Thank
You're welcome. And for those of y'all who are wondering, this is water, not an energy drink. Because we always get that. Like, what do you guys shouldn't be drinking those energy
You
drinks.
ain't gonna sleep tonight, brother. It's
It's just water. It's water in a can.
If that's your story, stick to it.
Now, I'm gonna take a wild guess. Where you from?
Guyana.
Guyana? Okay, cool. I was wrong. Okay. How are
What
you?
were you gonna say?
Oh, I was gonna say with your sense of humor, I thought you was gonna be from New York, because people from New York always have an
I
interesting
live
sense.
in New York. I've
Oh,
lived all
see?
my
I
adult
knew it. I knew it. I knew it.
Even though my son defected and went to Chi-Town, can't.
Ain't nothing wrong with that. Ain't nothing wrong. Look, nothing wrong
She
with that.
said
Okay?
defected.
Did married a gal and decided Chi-Town is where it's gonna be.
He left for love. I ain't mad at him.
Yes, he did.
Him.
Good evening, guys. Awesome, awesome, awesome. I actually did a class with Mark Kohler, so love the idea that that's your mentor.
Oh yeah. Speaking at his conference next week, so it's gonna be fun.
Yeah.
Big guy.
My question is simple. I have two real estate properties, have monies invested, like you said, 401k, IRA, have that. I'm thinking about, I heard that I can do a withdrawal from my IRA to buy another piece of real estate. Do you recommend me doing that? There's equity in both properties, but I took equity out of one property last year and took care of some other stuff. The other property has quite a bit of equity, but in my mind, I don't want to touch it.
You don't want to touch the equity in your other property.
I'm sorry.
You said you don't want to touch the equity.
Right. I was thinking that I shouldn't.
Okay.
That's that one is my primary residence.
Okay.
So my thought process is, should I do a withdrawal from the IRA, or can I borrow from it?
Okay, good question. Again, so going back to the last person, obviously we want to understand the goal and what does the math say. So if you were to withdraw, is this a traditional IRA or a Roth IRA?
It's a Roth.
It's a Roth. Okay. Well, technically speaking, all the contributions you made to the Roth, you can access anyway, right?
Yes, but they did tell me I can withdraw from it.
Yep. So you could withdraw. So that's one option, right? And so then it's a simple math. So now we don't have to worry about, the tax or penalty implication, but we got to just worry about the ROI. So we got to look at what has been the ROI of the money that was invested in the Roth, and what is it likely to be going forward, right? If we believe that investing in this property is going to be a better bet, then it could make sense to withdraw. Now, if I want to keep the money inside of the IRA, but I want to borrow against it, now the caveat there is what type of IRA is it, right? So if it was in like a self-directed IRA, right? Cool, you could borrow, you could borrow from the account, buy the real estate, but then also you're going to potentially lose some of the tax benefits of real estate in doing so. So we got to, I guess, really think about what the goal. If the goal is, well, let me just ask you, instead of assuming, what is your goal by buying this additional real estate? What is ultimately your goal?
It's to buy a property to flip, fix and flip.
Buy a property to flip. So you want to buy a property, flip it. Okay. And what do you want to do with the money from the flip? What do you want? What do you need that money for? Or what do you want to use the
To
money for?
continue the process, just to get more doors. Just
Okay. So you don't necessarily need the cash flow from you don't need that to live your daily life, right? You're not taking the money from the flip and then going to go on vacation or buy another car or nothing like that. You're just using the money to reinvest to continue to buy more properties.
Yeah, I mean, some of it they would use to pay, whatever. Okay, I have a couple of bills to take care of, whatever. Yeah, but the primary goal is not to say, like you said, to buy another car or something. No,
Yeah,
it's
I'm asking because again, that would determine which strategy makes the most sense, right? Because again, if the money was in like a self-directed IRA, sure, you could get the money, buy the property to flip, but then you'd have to put all the proceeds, 100% of the proceeds back into the self-directed IRA if you
okay.
did that, right? But since it's a Roth IRA, I don't think that makes sense. I would probably withdraw if I felt like the profit that I was going to receive from the money from the flip was going to be substantial. And then I would either one, continue, like you said, to buy more real estates with that profit because you can withdraw that money from the Roth IRA without penalty. But if you were to have the money inside of a self-directed IRA, the challenge with that is number one, you're going to lose the real estate benefits. But it sounds like when I say real estate benefits, I mean from a tax standpoint. And then two, it sounds like you don't necessarily need most of the money, but you might use some of the profits for other reasons. And you can't do that with the self-directed IRA. So if the math makes sense, I would withdraw.
Oh, you withdraw and not borrow from it, just withdraw.
Correct.
Okay, got it.
Yeah, it's not taxable because there's contributions. So point of borrowing from an account is the taxes,
To
right?
avoid the taxes, right?
Yeah, you can't borrow against an IRA, so the money's will be taken out anyway. So it's the same thing.
Correct. Keisha.
Hello, everyone.
Hey, how you doing?
I'm doing good. I have a quick question. I had my LLC business license revoked for non-payment of fees. I'm interested in reestablishing the LLC. The cost it's been revoked for a few years now, but the cost is, it's like $3,000. I'm wondering if it's better to pay the fees and just reinstate the license or go ahead and establish a new LLC.
What is the business for? Like, what type of business is it?
Uh, it is for real estate. I have two properties and I have the properties currently in trust, but was wondering if I should have them in the LLC. So I'm still trying to sort all of that out.
So currently, the property has no LLCs inside of it, right?
Correct.
So yeah, there's no chance I'm paying $3,000 to reestablish it.
No chance.
Okay.
Yeah, absolutely not. We're gonna start this thing over from the top. Get a new
Okay.
LLC, and then we're gonna keep it rocking. We are not
Okay.
paying $3,000 to reestablish up next month.
Because I was thinking like, I pay the fees. Do I end up writing that amount off? I just wasn't sure where to go with it.
Yes, this is a point I want everybody to hear. So thank you so much for saying this. Okay, I cannot be more clear when I give you all this understanding. Okay, when you write off something, you are spending $1 to save 37 cents at most.
Oh.
So if I'm in a 37% tax bracket and I spend $1 to write something off, I'm spending $1 to save 37 cents. I still lost 73 cents. So what does that mean? If
Not
you
worth it.
spend unnecessary money, if you're going to spend unnecessary money just to get a tax deduction, that is what we call hustling backwards. So yeah, you would get a $3,000. Yeah, you would pay the $3,000. You would 30% tax rate. It'll save you $900, but you still spent $3,000. So let's not let tax deductions blind us from the ultimate goal, which is keeping more money in our pocket overall.
Okay. All right. Thank you.
Got it. Yeah.
Hello, hello.
Hello. I have 401k, IRA, a suite of questions around that
Sure.
that are all interconnected. So
Okay.
if I am maxing out my employer's pension plan with the 23,000 and they're matching 10.5%, but they're pretty generous. And then there's another part, they have a plan A and a plan B where you can also take payroll withholdings up to some amount like $70,000. That is also a retirement account, like a plan B type of retirement account.
Mm-hmm.
Am I still eligible for this $70,000 that's related to a business, a side business? Or is at some point, is there a limit on how many 401ks and pension plans I can have hanging out there and maxing out in various locations? So that's kind of the first part. Second part is then, how do I get into this backdoor Roth? How do I do the backdoor Roth off of some of the accounts that I have?
Mm-hmm. Sure.
And what is a self-directed IRA? I open up an IRA every year, but I'm not sure what the self-directed. So that's kind of my little suite of questions around
Yep.
401k and IRA.
All right, so I got good news for you. The last part I'll touch on at a high level because I'm going to cover in depth on Wednesday, but I'll touch on a high level. The second part I'll answer today. And since the first part of the question is pretty easy, Carter, you can answer that piece in terms of the limits on 401k accounts and contributions from a tax standpoint, because that's essentially what she's asking.
Yeah.
Cool.
It's combined. So you can have 100 401ks, but it's 70,000 across all of them, right? So yeah, the same thing with IRA, same thing with HSAs. It's consolidated amount across all accounts.
Yeah, so that's easy. Cool. Now, backdoor, right? So for the benefit of the room, why would we want to do a backdoor Roth conversion? What is a backdoor Roth conversion, right? So, and team, you can bring it back up while we're answering the question. It's fine because I got another 2 minutes to get to the question. So backdoor Roth conversion, right? As we know, or maybe we don't know, Roth IRAs are not taxed at distribution, right? So the reason why people want to get money into the Roth IRA is because when you retire, you're gonna be on fixed income, and the last thing you want is to have to worry about unnecessary taxes, right? So if you have a lot of money in traditional IRAs or traditional retirement accounts, the concept of backdoor Roth IRA is how can I systematically get some of that money over, right, into the Roth IRA so that by the time I get to retirement, I have more tax-free distributions, right? So the question is, how would you take advantage of that? How would you do it? Now, I'm assuming, is all the money that you have in these retirement accounts, is it in service, meaning that it's with your current employer, or no? I'll take you off mute. Hold on. Go ahead.
I had a retirement from federal government thrift savings that's totally separate. But what I'm talking about now that I'm doing is with one singular employer.
Okay. So the money that's with your current employer, where you're currently still getting paid from, that is what we will call in-service money. And we could not take advantage of backdoor Roth IRA withdrawals just yet, right? Because the money is in service. Now, if you have any other outstanding 401ks or qualified retirement dollars that are not with the current employer, we could do it. But from a tax strategy standpoint, we want to determine when is the best time to do it, right? Because while it is a great strategy to mitigate taxes at retirement, you are going to pay taxes on that money, right? It is going to boost your taxable income, I should say, for the year that you do it, right? So we want to be thoughtful about the timing of it. And so typically what we're recommending for our clients is we're looking at a cadence as we're approaching retirement, like maybe over a 5 to 7 year period where we already determine, okay, cool, we're going to convert this amount this year, this amount the next year, this amount the following year. And we're going to do it at a threshold that's not going to bump us up into another tax bracket, so that we can do it systematically. But it's pretty simple, right? In that regard, we're looking at what is our taxable income is going to be for that year. How much do we want to convert in order to do so systematically? And then we'll pick out our timeline of how many years we need to do it in order to have the money fully converted by the time we retire. So for you, if and when you transition jobs, that is when you would be able to start taking advantage of doing it for those resources. You wouldn't be able to do it before. Now, that's not the end of the world if you plan to work there until you retire, right? It just means that maybe we are mixing your strategy with having some money in a brokerage account, some money in a high yield savings account. So that way you can, in the early years of your retirement, you have money that you can leverage for cash flow while you are systematically converting some of that money over through by way of a backdoor Roth conversion, which could actually be beneficial because naturally you're gonna be making less money at that time because you're no longer receiving active income from your employer, right? But the strategy remains the same. How do we mitigate our tax liability as we're converting? And then systematically move that money over so that we have tax-free distributions when it's time to actually use the money. Does
So
that make sense?
it does, I can do it from can I do it from the TSP?
Is the
Since I don't
TSP
work,
no longer in service?
yeah,
Meaning,
it's no longer in service. I left,
unless there are some, because that's typically like government, right?
yeah,
Government or okay, yeah. So you should be able to, unless they have some special provisions. I mean, that won't allow you to. You should be able to because it's no longer in service. Where's the TSP now? Is it still at the
still at the, I guess, Office of Thrift Supervision.
Okay, well, what I would do is I would call them and ask them like, "Hey, can I roll this qualified money, or can I roll this money over into Fidelity or another investment institution?" And then once that happens, I'm pretty much 100% sure at that point you'd be able to start systematically converting over.
As soon as they open up, I'll go.
Oh
Yeah,
yeah,
the
right, right.
shutdown is
As soon as they open
crazy.
up, right? The shutdown is crazy. Yeah,
Yeah, that's crazy.
yeah,
That's been going on almost a month now, dude.
yeah. It's wild, wild, wild times. America is being really ghetto right now.
Stay inside.
Miss
Ruby.
Ruby.
Hello, my name is Ruby Rodriguez, and I have somewhat of a scary question, I think. My business is about 3 years old now. In the second year, well, 3 years old this year. So last year, um, my business made way more money than I thought that I had made. So when I did my taxes recently, and I've only been doing my taxes. I've been trying to do everything myself. I did obviously not prepared. That's why I'm in this in this series. Um, Anyways, long story short, she tells me that I owe $17,000 in taxes, and I'm just wondering what I could try to do to lower that because I cannot afford to pay $17,000 in taxes. She said I should have been made, and I should have been an S corp now, but I didn't S corp. I didn't know anything about that. I also have two kids that worked for me during the summer, and I paid them cash. So that's another thing that I'm a little worried about too. So I just don't know how to fix it.
Well, so I have good news-ish, and I got other news-ish. Um, the good the good news is the IRS does allow you to set up what's called payment plans, so you can do it over 5 years, right? Very nominal interest rate. You can put that amount on a payment plan and pay it over 5 years, 60 months, and not have to pay all that right now. And as you make more money in your business, you can pay it off in chunks. The bad news is you can't go back in time and implement tax strategies that should have been implemented at that time. So yeah, you should have been an S corp. You can't backdate an S corp election for last year. Yeah, you should have paid your kids, kind of did pay your kids, but You pay them cash, you get audited, you're losing that 7 days a week and twice on Sunday, right? So I think the most beneficial part is that now you're learning what to do for this year, and you still have 2 months of this year to be able to make sure that what happened to you last year doesn't happen to you this year. But as far as like old payments, like if you miss tax deductions, we can add them back. But if you just didn't implement the tax strategy, there's nothing we can do about that, which is why it's so frustrating for people not having a tax strategy team, because they meet with their CPA in January, February, and they tell them the coulda, coulda, shoulda, woulda. Like, oh yeah, you should have been S corp last year. Where were you? Like, you know what I'm saying? Like,
Yeah. I
so
didn't expect it to grow as fast as it did, and we were getting work left and right. And that's why I was like, okay, I brought my boys in. I started this business all by myself. I did my LLC. I got the clients. I did all that stuff. And I was so focused in that I thought, okay, I can do it myself with Intuit and QuickBooks and yada yada. And we get busy, and then I get the tax bill. So I'm like, oh my God.
yeah, yeah. And again, I would, still file it, because the failure not filing is worse than the failure for not paying.
Yeah.
File it, put it on the payment plan, pay it down, gradually with the money you make this year, don't, and then not make the same mistakes. One thing I will say that will help you and everybody in the room going forward is we just recommend having a tax account and putting away a certain percentage of that money throughout the year that your business makes. So if you have a business that's doing pretty good, you can set aside 20%, 15, 20% into a separate account. Every dollar that comes into the business, that money goes to that account. We're not going to use it to pay estimated tax payments, but we're going to use it in case we have a tax bill. We're going to use it to implement tax strategy, right? So that is what I want you to do going forward. Everybody has a business. If you put parking some money aside, because if not, you're going to look at the end of the year, but I don't have the money, because you should have been setting it aside throughout the year. So that would be my recommendation. I know it's not the news you wanted, but I think a payment plan will take that pressure off your back.
Okay.
Yeah. What'd she say?
What was that?
Does the IRS dictate how much we can pay?
They give you a rate. Once you sign for the payment plan, they
Okay.
basically take it, divide about 60 months, and then give you an interest rate, and they let you know what the payment's going to be.
Yeah. And the good news is that's a good problem to have. I know people, like, when they're learning tax strategy late and they're mad they got to pay the tax. If you have a tax bill, the good news is you made money, right? That's the good news is. Now we got to take advantage of the strategy so that we don't overpay the Uncle Sam in future years. All right. Megan.
Aloha, how's it going?
Spectacular. How are you?
Good. So my question is, if I sell my house and I have 400 to $500,000, sorry, my dog, um, what's the best way for me to not pay taxes and use that money to make passive income?
Are you married?
Single. I have a
Single?
13-year-old and a 16-year-old.
Okay. Well, I know at least, I'm assuming you've been living in the house 2 out of the last 5 years?
I've been here, yeah.
Okay. Well, at least for $250,000 of that, you don't have to worry about. Now, if you said you got about $400,000 that you're expecting in
4 to
equity,
5.
4 to 5. Okay. So the homestead exemption will take care of half of
150.
that.
Yeah.
For the other half, Carter, what do you think?
Do you need to use the money? Do you need to actively use the money, do you want to use some of that money to live off of and things like that?
I want to use some of the money to travel for a little bit, and then I want to either structure it for accounts that make passive income, like raw, whatever it's IRAs or whatever that is for retirement, or I have other money though that's already in, like a life insurance plan. And then I have one retirement plan with $30,000 in it that I can move to something that's higher interest rate.
Yeah.
Or set up like Airbnbs. I want to live in 3
Okay.
different countries
Gotcha.
though with those.
Okay. So it sounds like the bigger ask, obviously we always want to pay less taxes, but the bigger ask is, with the profit that I'm going to get, I'll earmark some of it for, travel and whatnot, but how can I maximize the money that I'm going to be receiving?
Yeah.
Yeah. So it sounds like there's never a what's best. It's a matter of what is in alignment with your lifestyle and risk tolerance, right? So, and currently, what is the economic environment, right? So, if the money that you invest, are you trying to generate passive income in the sense that you want to receive the money, or you want to preserve your capital and continue to grow it? Because that's going to be a difference.
I
Okay.
want to do both, but like I said, I have a life insurance plan and I have a retirement plan. So I
Okay.
could be taking the retirement plan and making that being a
Yeah.
bigger account that gets like 8%, more of like a safe
Yeah.
account.
So here's what I would, if it were me, here's what I would do. Right. What I would do is, at least from the asset piece, from the investment piece, Carter can speak to anything you can do to offset the other taxes that you might owe on the difference. From an investment piece, what I'm going to do is I'm going to invest the money into a brokerage account, following the strategy that I teach our clients. I can give you some sample holdings without knowing your risk tolerance. Obviously, still do your research. I'll put it in the community. I'll give 20. Matter of fact, would it be helpful if I give 25 stocks that are currently inside the S&P 500 but are performing substantially better than S&P 500? Would that be helpful
Yes.
for anybody? Okay, cool. So again, do you guys do your own research? I did some of the heavy lifting, but you guys can take it from there. I would recommend open a brokerage account, investing the majority of the funds in there. Then from there, I would identify maybe a real estate property or two that I can put a down payment on for a long, maybe it's still some Carter's thunder. Maybe I invested into a short-term rental, right? Because if I borrow against the portfolio, invested into a short-term rental, then I can take advantage of the short-term rental loophole, which potentially could then offset some of my tax liability. But either way, I would invest the money in a brokerage account, borrow against it to buy cash flow producing asset like real estate, and then from there, identify what is the best thing I can do to offset the remaining amount of money I'll pay in taxes. Potentially, it could be a short-term rental that you invest in to take advantage of the short-term rental loophole. So that would be my high-level 30,000-foot overview recommendation.
Couldn't have said it better myself. Couldn't have said it better myself. All right, this is the last question of the day. How you doing, brother? I want to try to pronounce your name. I'm gonna butcher it. Can you help me out?
It's Harjinder. Can you hear me?
Harjinder. Yeah, I got you.
Our gender. It's actually just like it looks.
Like, look,
Yeah,
I was just scared. I
that's
was just
exactly
scared.
what it is.
I was
Yeah,
just
thank you
scared,
for
bro.
taking my question. I was worried like I'm gonna miss out. So thank you for
No,
that.
no, the team made sure. Yeah.
Yeah. All right. So I have a question. So I have a high paying W2 job and I started a business this year and with God's grace, it's done pretty well. And I'm at to a point where I'm thinking of leaving W2 and then going full time into the business. Now, obviously, listening to you guys yesterday, setting up LLC and S Corp and then, doing payroll and all that stuff, I haven't done any of that. And I need to set up an S Corp with an LLC and all that stuff. Question is, obviously, you guys I think already have answered most of the things that all the profits that I've had so far for the year. I can use those to bringing into the S corp and take care of my tax advantages, right, for expenses and other thing. Question is, if I want to start paying my kids for payroll, can I go back and do payroll for previous months, or can I only do the last 3 months that are left over?
So I'm going over that today. So I don't want to steal my thunder. I'm going over that today.
Okay.
But yes, you can make up for the year in the last 2 months with in it if it makes sense. But yes, you can, like, the last 2 months, you want to do payroll, you can pay them X amount per week for the last 8 weeks of the year. You don't have to go backdated. You can just pay them the whole amount for these last 8 weeks of the year. So it's not too late to implement paying your children from your business. Now,
Okay, so instead of breaking into 3 months, break it into weeks for the
well,
remaining
yeah,
20.
just weeks or like bi-weekly. I would do it at least bi-weekly though. I wouldn't do it monthly. I would do it bi-weekly. And it's not too late to make the S election for 2025. The latest I like to do is November 15th because you can retroactively make an S election back to the top of the year. And you
Okay,
just have
so
to.
I have till November 15th to make that selection. That'll set up an LLC and S Corp.
Yeah, that's the latest. Like, that's pushing it, or you just have to wait till next year. But that's like the latest.
Okay. Now, a follow-on question to that is that since I'm thinking of leaving W2, hopefully my business will do well, but there's a chance that because I'm losing my W-2 income next year, my total income may be less than what it is I earned this year. Is there a way I can shift any of the profits or expenses to in such a way that, hey, they can be shifted to next year so that I can balance it out between the two? So I don't pay too many taxes this year, but balance it out for next year.
Yeah, if business is less than 25 million are on cash basis accounting, so all expenses and income needs to be recognized in the year they were incurred. So you can't really play the game of like if I spent the money in 2025, that's the deduction needs to happen in 2025. And the good part about that is that I can spend money that in 2025 that I didn't need to spend it to 2026 because I'm on cash basis, but you can't delay expenses if you already paid them because you're on cash basis accounting, meaning the deduction and the income needs to be recognized the month and the year that it was incurred. Now, friends, can we do that thing? I know class about to start, but can we do that thing I want to do before class starts, if that's possible? Yeah, we run a little bit behind y'all. We're gonna make it up. I just wanted to make sure we got all the questions today. It was something I wanted to do. Hey, Denise. I know you didn't have your hand up. I just want to say, hey, how you doing? You gotta come off mute.
Oh, you gotta come off mute.
Can you hear me?
I can hear you.
Okay. So I know you didn't have your hand up, but me and George was thinking last night and this morning and just about how brave it was for you to come up yesterday and ask your question, even with all the things that you're going through. And I kind of felt like you kind of put the burden on yourself that you didn't file the taxes that you're supposed to file when you were literally being there for your husband and doing what you're supposed to do. So one, I didn't want you feeling bad about that. But two, I wanted, and me and George wanted to know if it's okay with you if we pay our team to do those 2 tax returns for you and get you back caught up.
Oh, that would be wonderful.
That would be amazing.
That would be fantastic. Oh, that would be a blessing. That really
Well,
would be. You just tell me what you need and all of that. Because I'm going to tell you something else. I use that software, Tax Free USA. And if we have a minute, we purchased a property before my husband died. And when I used Tax Free USA, it never asked me a question about what were the events that occurred in 2022, where I would have told them I purchased a rental property. They never asked it. So now I got to go back and figure out how to get that. That's why I held back to 2022, because I wanted to get that piece in there.
Okay.
You understand?
Well, yeah, I understand. And that's why the software is they're not the greatest. But we talk with our team. We're going to pay for 2 years of your tax returns. So our team is going to reach out to you, and then you'll be
Oh,
connected to tax
thank
preparations.
thank
And
you so
yeah,
much.
we'll get
Thank
you.
you so
you're
much.
so welcome.
Yes.
That you are truly saints.
Blessed to be a blessing.
The
We thank you
blessing
for
is
we
a
thank you
Well,
for
at least
showing up for yourself, and it's just a small way that we want to let you know that we're rooting for you and that the best is ahead, not behind.
I believe that, and you've given me renewed hope because it gets a bit depressing.
understand. Thank you so much for
Thank
allowing me to do
you.
that.
You're
Yes.
so welcome.
Thank you so much.
You're so welcome.
Cool. All right, team, we can play that video as we grab some water, then we can get right into class and we'll make up for this lost time. Somebody stop cutting onions in this room.
In the last month of the last quarter of last year, saved me over $320,000 in taxes.
We are here to claim our dreams, that it is possible.
I think it's fair to say this has been nothing short of life-changing.
Nigeria, Lagos, and Aboja, tax-free.
Give all the game on not only how to make your money, but how to keep your money.
I have a lot of clarity around the best investment strategies for me to build generational wealth with my business.
This mastermind just has been on top of the game 100%.
I'm still completely floored. I'm telling y'all, their mission of helping Black families, they're doing it literally step by step.
Doubled my income last year, but I saved more in taxes and received I have it with me, $38,000 refund check.
Get a family with you, a huge community that's going to hold you accountable, that's going to cheer you on.
Get in here while you can get in here. You feel me? Let's get it.
Okay, guys, welcome back to day 2 of the 5-day wealth workshop. That was just a video of some of our clients sharing their stories and how working with us has helped them save on taxes and obviously build wealth, which is the ultimate goal. Now, before we get into class today, I wasn't going to bring this up to tomorrow, but I checked school and I got 1, 2, 3 direct messages from a few of you all saying the same thing. And the message goes like, yo, yesterday's class was amazing, but I can't do this on my own. Can you help me set this up? Like, did anybody else have that feeling yesterday? Like, yo, it was amazing, but then you start losing sleep. Like, how do I actually do this for me? Right? And so for those of you all that didn't come to the masterclass, we said it then, but we'll reiterate it here. The point of this 5-day workshop is to give you the awareness to the strategies that you should be privy to. Okay? And because we believe that you cannot be what you cannot see. So our goal with this 5-day workshop is to give you the strategies that we use with some of our clients so that you can see what is possible. And at the end of this training, or actually on Thursday, we're going to be opening up the opportunity to have us do it for you. Right? So for those of you all that want more than education and want help and want to work with advisors and the CPA team, that opportunity will be talked about on Thursday, because we don't want to just give you information. We want to help you with the implementation, right? But so I want you to not stress yourself out today, tomorrow, and Wednesday, thinking about how you have to do this on your own. Simply learn it. And then on Thursday, if you want us to help you, then we'll talk about what it looks like to help you. If not, that's cool. But I just don't want y'all stressing yourself out about the how. Just focus on getting the knowledge about the what. Okay, cool. Bet. All right. So I want to do a quick illustration before I teach the first part of class. So let me see. I want to pick on somebody. It was somebody I want to pick on earlier. I saw let's see. Who do I think will be a good candidate? Let me put my screen over here. Give me 1 second, y'all. There we go. Cool. Now I can see more faces. All right, so let's do this. If you wouldn't mind, could you come up here? Amy? Yeah, Amy, why not? So can we bring I'm gonna go ahead and bring Amy up here at the spotlight. And then George, I'll take you down for this session so you don't have to sit there. Amy, how you doing?
I'm never lucky. What happened?
Well, you're lucky today.
Today's your lucky day.
Oh my God, I go buy a lotto ticket. Amazing.
Well, Amy, it's actually really your lucky day because I have an amazing opportunity for you.
Tell me.
Okay, so I have this $100 bill. Okay, now I want to trade you this $100 bill for a $10 bill. Is that a good deal?
No.
No. For you?
Oh, it's a good deal for you.
No, I want to trade you this.
Oh, no, yes, I want that $100 bill. Sorry,
Okay,
yes.
unless
For
you
me,
don't
it's a
want
good
it.
deal.
Unless you don't want it.
No, give me the 100.
Okay. I was making sure you was with me. Okay. So I want to trade you $100 for $10. Small problem. You don't have $10. Okay. Now, before I go any further with the example, are you going to let not having $10 stop you from making a deal where you could trade 10 for 100?
I don't know what the right answer is, but I guess no.
There is no right answer. It's Amy's answer. It's just Amy's answer. There's no right or wrong here. Okay.
I mean, I'll try to swindle a deal for the $100.
Okay. So and the reason I asked you that, Amy, is because the difference between, at least what I know about successful people and not successful people, is not their resources. It's their ability to be resourceful, right? They're gonna figure it out, right? So you're gonna do what it takes to get this $10. Now, let's say you got this, all you got is this room full of 640 people that you met yesterday. What are you going to do to try to get this $10?
I'm gonna start borrowing money, man. Everyone give me a penny. There's like 650 people on this call. What does that equal? Give me some math.
Okay, cool. So you will borrow the money. All right. So let's say the only person that will borrow you the money is let's say the only person that will borrow you the money is Herbert. Now, here's the problem. Herbert is a loan shark. So Herbert says, look, Amy, I'll give you 10, but you got to give me back 20. Are you going to take that deal?
I mean, to make the 100, sure. Because then I still get $80 out of the deal, right?
Yeah, yeah. But you do realize that's 100%
I
interest
put
rate.
this out there that I'm not your math friend
No,
here.
no,
So
I'm
yes.
just, Amy, we're asking questions, right? We're asking questions. You do realize that's 100% interest rate on that loan you just took because he gave you 10, you get it back. So that's 100%. You still want to pay that?
No, I guess it depends if I'm desperate for the money. But
Okay.
no, I mean, no. Maybe, I don't know.
I'll let you final
I'm
answer.
really bad on the spot,
Yeah.
man, but I'm like
That's
so
what I mean.
excited you called on me. I just don't want to waste your time waiting for me to do some math. But whatever all these people are saying, let's go. We'll take it.
There is no right or wrong answer. I want Amy's answer. So final answer, yes or no. You go take that deal.
I'm gonna take it.
Okay. Great. Great.
Let's just assume I really need that money. I'll take it.
Yeah. So Amy, that is a great answer. And that's the answer I hoped you said because you just made $80 from no money. Right. So Amy, what it sounds like you're saying is that like as long as the return on investment is higher than the interest rate doesn't really matter. Okay. That's amazing. Amazing. So Amy, you just blessed the room with a lesson because, and here's a lesson I want y'all to understand. The interest rate does not matter if the return on investment is higher. But here's the thing, y'all. When I made Amy focus on the interest rate, she almost gave up the money. And the reason why a lot of us are not making the money that we should is because we're so busy counting somebody else's pockets that we forget to count our own. Like the lesson I want y'all to take from this is like, don't let counting somebody else's pockets stop you from blessing your own. If you make more money off the borrowed money, then what do you care about what the interest rate is? And so, like, the lesson I want you all to understand is that if, like, interest rate doesn't matter if return on investment is higher. And wealthy people, I'm sorry, Amy, I'm gonna let you get off stage. I know you're
No, I love it. Thank you.
Okay, okay. So, Amy, is it okay if I give you this $100 for being a good participant? I'm gonna have the team send you $100. Is that okay?
I mean, honestly, like I am a high earner here to learn strategies. I'd rather you gift it to somebody that might need it more than myself. Like I loved what you did for Denise. That was so heartfelt and lovely. Like give that money to somebody else here. I'm good. I just need to learn how to like, do some things better in life. So
yeah, I love that. We'll make sure it goes to somebody. And Amy, so seriously, sincerely, thank you for your participation. So I want y'all to understand, like society has got us so fixated on being debt free, we forgot what debt free is. Like you do realize that getting back to being debt free is just getting back to zero.
Mm-hmm.
So many of our financial goal is just to get back to zero. Right. And I encourage you all that we all deserve a better financial goal than getting back to zero because wealthy people understand that the purpose of debt is to use debt to buy assets and then use the money from the asset to pay off the debt. So wealthy people use debt to buy real estate and they use the money from the real estate to pay off the debt. Wealthy people use debt to buy businesses and they use the money from the businesses to pay off the debt. And if you want to start earning like the 1%, you need to start first thinking like the 1%. And we're going to be giving you all strategies that might require debt to use them. But if you're scared of the debt, you're going to miss the strategy. Did that make sense, y'all? Because I also want to free you from the shackles of counting somebody else's pockets and forgetting that your pockets are being blessed in the process? Okay, cool. Well, I hope that lesson was helpful for you all. Shout out to Amy for being a real one and not taking $100. That was dope. That's let me tell you something. That's never happened before. That's
Never.
never happened before. Okay. So George, I'm gonna try to get through this paying your kids in like 10 minutes. I'm gonna give you the floor. If we go over a little bit tonight, bro, just go over a little bit. This is what it is.
Cool. All right.
Okay, cool. So, let's get into it. So, today we're going to talk about paying your children from your business and revocable living trust, right? So I'm going to teach half the class, George teaches the other half of the class. I'm going to try to get this lesson as fast as possible to keep us on, a proper timeline for today. Okay, so paying your kids, right? Why do we want to do it? Well, here's what most people do. Most people, they make money, they pay taxes, and then they give their kids money. What I want you to do is to make money, pay your children, get a deduction for paying them, and then have your kids receive the money tax-free. Because what happens, what happens if you don't do that, you're paying your children with after-tax money. I want you paying your children with pre-tax money. Okay? So paying your children allows you to save on taxes and them to get the money tax-free. So overview of the steps. So what to do, right? So I'm about to share my screen and we'll talk about what to do. Okay, paying children. Okay. Here are the steps to paying your children from your business. Number one, and my screen should share. Going once, going twice. Oh, it's not plugged in. That's why. Give me 1 second, y'all. Technical malfunction. Here we go. And there we go. All right. So number one, they have to be the proper age, right? So we recommend that if you want to pay your children from your business the tax-free way, they need to be between the ages of 6 and 17. Okay. Now, can they be younger than 6? Yeah, if it makes sense for your business. If you are like Rihanna and she has Fendi and she can put her daughter in her Fendi commercial and pay her daughter for being a 2-year-old model, that makes sense, right? Or if you can be like Jay-Z and Beyonce that put Sky on a song of their album and paid her for her services, then yeah, it makes sense you can pay a 1, 2, 3-year-old, right? But if your business does not need a model, then you cannot pay them if they're below 6 years old. Okay. So can it be younger than 6? Yeah, they could be a model, but the question is, does your business need a model? Can they be over 17? Yeah, but it won't be tax-free. So to do it in a tax-free manner is ages 6 and 17, right? So that's number one. Number two, if they're of the right age, you want to determine the job, AKA you want to assign them a role, right? So you want to give them a job title. So they're going to be your social media person, they're going to be your assistant, determine the job, assign them a role. You can come up with a brief job description, whatever, okay? So they actually have a job to do in your business. Step number 3, you want to log the hours, okay? Now, if your kid's going to work 20 hours a week, every week, all year, then you don't have to log every single hour because they work 20 hours a week they work the same hours every week, right? But if you're having them do one-off jobs, you should keep an hour log, right? Just to prove in case of an audit that you've tracked the hours your son or your daughter works in your business, okay? So you want to document the work or AKA log the hours. This strategy specifically is for your children. There is a strategy for grandchildren. It's a little bit complicated, but this is for your children or your married into children through your spouse. Okay, this is not nieces, nephews, this is your children. Okay, so that's number 3. Okay, number 4 is you want to pay them correctly, right? So you want to pay them correctly, okay? And what does correctly mean? Well, it does not mean through payroll. So we do not want to use a payroll software to pay our children. Okay, so we don't want to pay them via payroll. We don't want to pay them via 1099, right? Because if we pay them via payroll, the payroll software is going to issue them a W-2. The IRS is going to see that W-2 and they're going to say, hey, should we be taxing this income? When the answer is no. If you send them a 1099, if you pay them via 1099, the payroll company will also send them a 1099 and it's going to recognize that in the IRS's books as taxable income, which is not. So you don't want to pay them via payroll. You don't want to pay them via 1099. You simply want to do a transfer from the business account to their personal account. Okay, so you simply want to do a transfer from their business account, from your business account to their personal account, right? And I like you to do these weekly or bi-weekly, whatever floats your boat. And the total you can pay your children, each child, is $15,000 per year, right? That number goes up when the standard deduction goes up. In 2025, the standard deduction is 15K. So you can pay each child up to 15K from your business. Okay. Now, so you want to pay them after you pay them properly, you want to then categorize it properly, right? So on your profit and loss statement, it's not going to be contractor expense. It's not going to be employee or payroll expense. We're going to categorize it as outside labor. Okay, we're going to categorize it as outside labor. So these are the steps. Okay, so hire your children age 6 to 17, give them a job role or assign them a role. You want to log their hours. You want to pay them correctly, a transfer from the business account to the personal account. And then you want to categorize it on your profit and loss statement as outside labor, right? Because this is a category that never gets flagged or anything like that. But payroll and contractor, if you did it via payroll, they would expect the W-2s to match. If you did it via contractor, they would expect the 1099s to match. But this income is not taxable anyway. So that is the baseline of what to do. Now let's talk about the how to do it. Okay. So there's two different scenarios. Scenario one, if you have an LLC. Scenario two, if you have an S corp. Okay. So if you have an LLC, it's very simple, right? You have an LLC and you want to pay your child for the work they do in your business. Cool. All you have to do is transfer this $15,000 from your business account to their personal account. Okay. And you can do this via an online bank transfer. And the reason we want to do online is because we want to have a paper trail that we paid our children. Because IRS audits us, we want to say, not only do we want to show we paid them, we want to show that we paid them on a consistent schedule so that it looks clean. Right? So paying your children from your LLC is very easy. Now, if you have an S corp, things change, right? Because if you have an S corp, here's the thing: S corps cannot have children. Okay, S corps cannot have children. So if you have an S corp and you want to pay your children, you have to do one step, which is you have to set up what we call a family management company. You have to set up what we call a family management company. Now, this is nothing more than an LLC that you're going to call your family management company. Right? It doesn't even have to be an LLC. You can just give it a DBA and it'll be a sole proprietor and you get an EIN. Okay. So it could be an LLC or it could be an EIN with a DBA, sole proprietor, right? It's up to you. And we're going to call this Cofield Family Services, whatever, right? My S Corp is then going to pay the family management company a management fee of $15,000, right? And then that family management company, since it's an LLC or a sole proprietor, it can have kids. So this LLC or DBA is then going to take that $15,000 that I just paid it and is going to pay it to our children. So now the $15,000 goes into our family management company. So we get a $15,000 tax deduction here. And then the family management company, it receives $15K as income, but then it pays out $15K in expenses. So the profit and loss is going to zero out. So you're not going to have to worry about like any tax implications in the family management company. And then the family management company pays the child. Because since S corps can't have kids, we need to have this extra step in our payroll distribution so that we can make sure we're following IRS's guidelines. Okay? So that is how you pay yourself. That's how you pay your children if it was an LLC, and that's how you pay your children if it was an S corp. So let's put it into real practice, and then I'll be done teaching this lesson. So, so we had a client. They had an S corp, right? And this client was making about $250,000 in their business profit, right? That puts them in about the 30% tax bracket, right? Now, this client had 2 kids, right? 2 children. 110 and 115. So they had 2 children. So what we decided to do was because the S corp can't have kids, we had to set up a family management company for this individual. And then we made her children employees of the family management company, right? So what we did was, since she has 2 kids, we were able to pay this family management company $30,000 for the combined services of both children, right? And so $30,000, so she gets a $30,000 tax deduction, right, for the money that she paid the family management company. And if you take 30,000 times 30%, that is $9,000 of tax savings that we were able to get by paying our children. And the crazy part is she was going to spend $15,000 on the children anyway, right? So we were able to, instead of her just spending money on the kids and not getting a tax deduction, we paid the family management company $30,000, right? Okay. And then the family management company then took that $30,000 and paid it out to the kids in their bank accounts. Don't laugh at my bank, y'all. This is my bank. There we go. That's like a little bank, you know. So she was able to pay the bank this $30,000. So each of her children, I'll do it this way. Each of her children got $15,000. So this child got 15,000 and this child got 15,000, okay? Now here's the thing. Do the kids have to pay taxes on the money? No. Why? Because each child gets a standard deduction of 15,000. So their standard deduction is going to wipe out this income from being taxable. So not only did she save $9,000 in taxes, her children just received $15,000 each tax-free. Now, she was going to give the kids the money. She said, okay, cool, I'm going to spend this money on my children. We said, but wait, before you let your children go crazy in the mall and spend the money, let's talk about something. Now that your children have earned income, guess what they now qualify for? Now that your kids have earned income, guess what they now qualify for? They now qualify for a Roth IRA. And as we know, money that we invest in a Roth IRA is never taxed in the future. So think about it. We got a tax deduction for paying the children. The kids receive the money tax-free. And then we're investing it in the account that grows tax-free forever. Is it me, or did we just avoid taxes 3 times on the same dollar? Right? And here's the thing. If you do this from when your kids is 6 years old to by the time your kids turn 17, guess what? They will have $160,000 worth of tax-free money by the time they turn 18. So now guess what you just did? You just gave your kids the best 18th birthday gift they can ever have, which is options. Because now they can go to college if they want to, or they have $160,000 of seed capital for their business idea. And now think about it. The money that we invest in the Roth IRA, we can touch before 59 and a half. So $70,000 of that we can touch tax-free and penalty-free. So this is how we can use our business to set our children up for wealth at an early age. Okay? And here's the thing I want to leave you all with, and I'll pass to George so he can teach this part. You might have had to get it out the mud. But let's make sure your children don't have to as well. Like, if we know better, we can do better. So this is one of the strategies that if you have a business, you can set up for your children to help them, you save on taxes and help them build tax-free wealth. And now that you know how to do this, let's talk about some trust structures to make sure we protect the wealth. And that's my hat for the day.
All right. All right. I hope y'all learn. Are y'all learning something in this 5-day wealth workshop? I know it's still
Day
early.
and a half in.
Day and a half in. Y'all learning something about something? And keep in mind, Carter, one thing Carter mentioned is that you can pay your kids up to $15,000, right? Now, granted, half of that or 7,000 of that can go into the Roth. What I personally do is the other half for my son goes into a brokerage account, right? So for over 18-year period, he'll have about a little less than $800,000, right? By the time he turns 18, right? All because now you might be asking yourself, well, George, you have a 3.5-year-old. How are you doing that? Well, we have a merchandise brand, and my son is a model for the youth line. So even though he's younger, that is ordinary. That makes sense. And so I'm able to pay him. I was able to pay him pretty much from when he was 1 year old, and then invest the difference to a brokerage account. And I'm being conservative because that's only assuming the account grows at annual rate of return of 10%, which I'm happy to say that our account is especially more than that. So again, these are things that we wish we knew, right? Or we wish our parents knew, right? So that we could be the trust fund kids. But the good news is, you guys are learning this stuff now, and these are things that you can implement regardless of how old your kid is, and do it at the level that you think makes sense. Now, what good is setting your kid up that way if we don't create a generational wealth plan to ensure that they can do the same thing for the next generation or preserve the money that you are passing on to them, right? And that's why we want to couple this class with talking about how to properly set up your estate plan, right? So we're going to cover the essentials of estate planning in today's class, right? So I like to call this the financial security system, because when you're building wealth, right, you're adding in all these different layers, you're maximizing and optimizing your cash flow, right? You're building wealth through investments, you're taking advantage of tax strategy, and a whole host of other things, right? But imagine you having your actual dream home and you left the door unlocked, wide open, and you had no security system on it, right? That wouldn't be too small. I don't think any of us would do that, not in today's day and age, right? Maybe back in the day, right, where you could trust all your neighbors, you could leave your doors unlocked, but I don't think any of us would do that, right? So we want to make sure that with this wealth that we intend to build, that we are building a financial security system by virtue of estate planning. So what are we going to cover today? We're going to cover what is estate planning. Sometimes when people hear the word estate, it seems like that seems so grand. I don't have an estate, right? So I want to make sure I demystify the fundamentals of estate planning. Who needs an estate plan? The foundational elements of an estate plan, beyond the basics of the foundation. What is the Rockefeller strategy? Customizing your estate plan, understanding the risk of overcomplicating your estate plan, and ultimately keeping your estate plan current. Okay. So at a high level, what is estate planning? Estate planning is creating a plan for managing your assets during and after your lifetime. Keyword, during and after your lifetime. Oftentimes we think about it only from the lens of what happens when I'm no longer here, right? Ensures that your financial wishes are fulfilled and your loved ones are taken care of. Because here's the thing, whether you are temporarily incapacitated or whether you pass away prematurely or when you're supposed to, the last thing that you want your loved ones to be thinking about in the middle of grief is navigating your finances. We've seen it with people who make much more money than everybody on this call, celebrities, right? And people end up fighting over the estate all because there wasn't a plan in place, right? Documentation beats conversation, right? We got to have the right documentation in place. So that's one less thing we have to worry about when we're trying to preserve the legacy that we've established. Now, who needs an estate plan? Parents with minor children, married couples, single individuals, elderly individuals, business owners, people with significant assets, individuals with specific charitable goals, those with special needs dependents, blended families, anyone who wants to control their legacy. So what does that mean? That means probably everybody in this room needs some form of an estate plan. Okay? Generational wealth doesn't happen without a generational wealth plan. I feel like generational wealth has been the buzzword for the past decade. Everybody says, I want to build a generational wealth. I have a business, so I'm creating generational wealth. Okay, well, do you have a succession plan for that business? Right? Does your family member know how to run that business if you're no longer here? Well, I don't know if having a business in and of itself is a generational wealth plan. Or people say, I bought LLCs for all my cousins and now they have generational wealth. Great gesture, right? But we have to make sure that we're actually creating a plan, right? And not just adding more financial puzzle pieces without understanding how they all fit together. So let's talk about the foundational elements of a estate plan. So the first element of a estate plan is a will, right? And this simply outlines your asset distribution wishes, right? So let's say you have financial accounts, you have life insurance, you have all these different financial instruments or vehicles, right? And ultimately you want to earmark those things for specific people, right? The will outline who it's going to go to, right? Now, the challenge with that is your will will likely go through probate, right? And it doesn't necessarily dictate what is going to happen after you're no longer here. You can't necessarily control that, right? So if you just say this is for this person, this is for that person, great, it'll dictate who it's supposed to go to, but there's no guarantee on what that will look like when you're no longer here. If that makes sense. Which is why we advocate for our clients having a revocable living trust, because this outlines your asset distribution wishes while avoiding probate, right? So when the assets are in the revocable living trust, not only do you get to outline where the assets are going to go or who they're going to go to, you also get to determine what that looks like. So for example, if you have a young child and you say, okay, well, they can only access X amount of dollars until they do this. Maybe you want to make sure that they hire a financial advisor. Maybe you want to make sure they go through a financial literacy training. Whatever the case may be, you have parameters that you can set. You can't necessarily set those parameters when you just have a will. Okay. So that's why the revocable trust, living trust is an important part of it. If you have the desire to make sure that you're dictating what happens. And this is not about control per se. It's about preservation, right? Oftentimes the reason why wealth doesn't become generational is because we don't have a plan in place that creates the structure that will ensure that it's possible. Power of attorney, the legal authorization for financial and legal decisions, right? You're actually 3 times more likely to become temporarily disabled than you are to die prematurely. right? I'm actually a living testimony of that. When I was 28, I had a benign tumor that was growing in my ninth vertebrae in my spine. It fractured my spine. I had to have a surgery to remove the tumor, and then replace a part of my spine with metal rods and screws that still live there today, right? And so, luckily, obviously, I don't look like what I've been through because God is great, but that could have went a variety of different ways, right? And so if you don't have these proper legal documentations in place, right, then you don't know who can make decisions on your behalf, and it could get very interesting in those types of situations. Healthcare directive, right? Document your medical care preferences, right? You want to make sure that the wishes that you would like to happen in the event of certain scenarios are documented so no one's playing the guessing game with your life, right? And these are all the components of foundational components of an estate plan, which is why I wanted to emphasize while you're living and when you're no longer here. And I think what happens is the same way you have a business and you hear people say things like working on your business versus working in your business. You ever heard anybody say that before? Like the difference between working on your business versus working in your business. Oftentimes the day-to-day things we have to do are urgent, but things like this are important. And what happens is the challenging part is important things don't seem urgent until they are. Right? We feel like there are these things that we can delay. We can kick the can down the road. I'm young. I'm healthy. Right? There's these other things that I need to focus on right now. I'll get to it when I get to it. The problem with kicking the can down the road is eventually you will run out of road. Right? And so we have to slow down sometimes and allocate some of our energy towards working on our life and not just working in our life. I get it. We have a lot of things going on. You got kids, the kids got extracurricular activities, work is demanding. You're trying to eat healthy, drink your probiotic. Like, I get it, right? There's so much to do. But we have to make sure that with all the things that we're doing, we're not under prioritizing protecting what matters most. So let's break down some of the fundamental differences between a will and trust. So with the will, there's executor appointment. It allows you to appoint an executor who will manage the distribution of your assets. Guardianship for minors. A will enables you to designate guardians for minor children. Probate process. Wills generally have to go through probate, a legal process where a court oversees the distribution of your assets. We've all, whether we know it or not, have heard about this in some shape, form, or fashion. When you hear about, people like Chadwick Boseman or even Michael Jackson and people like fighting over the estate, it's public record, right? Once probated, a will becomes a public record. So then you're going to have cousins that you didn't know were cousins trying to come and stake claim on stuff saying, hey, I know Michelle for sure wanted me to have the Rolex collection. Okay. She told me herself that she wanted me to have the beach house. Okay. Activation after death. A will only becomes effective after you're no longer here. And then limited control over distribution. Provides instructions for asset distribution, but doesn't allow for detailed control over the recipients who use those assets, which I explained a few minutes ago. So that's a will, right? Better than nothing, but that's a will. Now, let's talk a little bit about trust. So trust avoid probate. Assets held in a trust bypass the probate process, allowing for potentially quicker and private distribution. Effective during lifetime. A trust can be effective during the grantor's lifetime, i.e. a living trust, and can continue after death if structured the right way. Privacy. Trusts are not public records, offering more privacy than wills. Greater control over assets. Allows for detailed stipulations on how and when assets are distributed to beneficiaries, right? i.e. based on age, other conditions, or educational requirements, right? Because you want to make sure that, the next generation doesn't mess up all the hard work that you did. And management and incapacity can provide for management of your assets if you become incapacitated. Now, let's talk a little bit beyond the basics. I don't want to go too deep here, but just so we all can be on the same page. For larger estates or specific needs or more complex tools might be necessary, which involve trust, tax planning strategies, charitable giving can also be provided benefits to truly round out your estate planning and your legacy. So, many of you may or may not have heard of the Rockefeller family, and they coined the phrase own nothing and control everything, or at least it was coined after the strategy that they put in place. And essentially what they did is they used a more advanced or complex trust structure for asset protection and tax efficiency. Now, a living revocable trust isn't necessarily designed primarily for tax efficiency. A revocable trust is, but in order for you to think about having a revocable trust, you need to basically have so much assets that you can predetermine that I'm not going to need any of this in my lifetime, right? If you can predetermine that, like, oh, I got 5, 10 million, I'm good. This other 5 million, I'm gonna earmark for my heirs, for my children, for charity, whatever the case may be. And in doing so and putting in an irrevocable trust, that can help you from a tax mitigation standpoint, right? And one of the other things that they did is they incorporated philanthropy as a key component of their estate planning, right? Now, I'm a big believer that we should have philanthropic efforts because we actually, out of the kindness of our heart and causes that we want to support, right? The government does incentivize us to give to those causes, right? But it doesn't mean that you can't do good while also doing well, right? So taking advantage of supporting some of your favorite causes, right? As a matter of fact, many of our clients often forget this. We actually have a foundation that's adjacent to our business, and we take a percentage of all of our profits and we allocate it to that foundation, right? Which means by extension, anybody that becomes a client of ours, they also are now participating in those respective causes that our foundation does as well, right? So we are doing it for the purpose of making sure that we are giving back and helping underprivileged communities and things of that nature, right? But in addition to that, you're still able to benefit from the tax strategy that comes from taking advantage of leveraging philanthropy. You also have to regularly review, right, and adopt different strategies based upon the tax law changes and changes in your family dynamic. So, for example, with the Rockefeller strategy, just to give you a high level overview, one of the things that they would do is they would essentially have assets that the trust owns. And then let's just say that their kid comes along, they go to college, and they want to start this business, right? Now, the trust could distribute, right? Could sell some assets and ultimately give them the money to start that business. But what they do instead is they say, you know what? We're actually going to borrow against the assets, ding, ding, ding. And we're going to give you that money as a loan at very favorable terms. Why? Because we're family. And that way we don't have to pay any taxes on the money that you receive. But one of the provisions and stipulations for you receiving this loan is that you get a life insurance policy, right, in excess of the amount of money that you want to borrow. That life insurance policy must be owned by the trust. So any amount of money that you borrow over your lifetime, when you are no longer here, that will automatically be replenished by the life insurance that is now owned by the trust, which guarantees that the trust never runs out of money, right? And so putting little provisions like that in place, that is how they're able to keep their wealth intact for generations. And on top of that, because they borrowed the money from the estate or from the estate planner, from the trust rather, then that recipient is not paying taxes on that money. So this is another way for them to escape the tax system. And the thing is, there's nothing wrong with this. It's just that we need to know the rules of the game, right? And we need to set perimeters and provisions in place that allow us to make sure that it can continue for the foreseeable future. Now, an estate plan should reflect your unique assets, family dynamics, and your goals, right? But it is important to balance sophistication with practicality. Now, some people, you might see a soundbite on social media and they say, you should get the trust submerged in the Cayman Islands, held in Switzerland. And that sounds good, right? It sounds good on paper. But Newton's third law of motion states, for every action, there's an opposite but equal reaction, right? For every tree that you see that has a lot of fruit, you have to ask yourself, how deep did they have to dig the roots, right? So let me ask myself, okay, based upon what makes sense for my family and my family's legacy, what does the level of complexity matter, right, relative to the outcome that I'm trying to achieve? Let's not get overly complex for the sake of getting overly complex. Let's understand what our family dynamic needs, and as a result, base our trust structure on that and that alone. Now, let's understand some of the risk of overly complex estate plans, right? So the first thing, which is obvious, is unnecessary complications, right? You introduce complexity before it's needed. It can lead to confusion, making management and understanding of the estate plan more difficult for both you and your beneficiaries. Have you ever had something you saved on your computer and there's like a folder within a folder within a folder and you forgot where it was? Like, man, where did I save that? Like that is kind of what it's like if you have an unnecessarily complicated estate plan. Increased cost. The more complex the plan, right, often comes with higher legal, administrative, and tax preparation costs, right? And we want to make sure, again, that we are implementing a trust structure that makes sense for us, but not doing something that's going to cost us unnecessary expenses and fees in the process. Reduced flexibility. Complex structures, especially irrevocable ones, can limit your ability to adapt to life changes or new financial goals. Like if you put assets inside of a irrevocable trust, you better know that you know that you know that you have no need or no desire to ever have any level of access to that money, right? Because it's going to be very hard and next to impossible to unravel that. Now, if you have a really good attorney, maybe there's some loophole you can take advantage of. But if we think proactively on the front end and not overcomplicate things, that's not something we have to potentially worry about. And then also it increases the potential for misalignment. A plan that is too complex might not align well with your current needs or objectives, leading to inefficiencies and missed opportunities, right? So we got to make sure that we are truly understanding what are our core estate planning needs, and then let that guide the decision on the structure, right? So what I would recommend is having a meeting with your significant other or yourself and figuring out, okay, like what do I want my legacy to look like? What matters to me? Are there causes that I care about? Are there people that I care about? What do I want that to look like? And any estate planning attorney that's worth their weight in salt, right? They can take that and then help you back into what is the right estate plan for you. Now, when we think about revocable trust ownership structure, right? There's things that the trust should own, right? And there's things that the trust should not own. And when I say should not own, I mean the trust should be the beneficiary of the proceeds, but it doesn't necessarily need to own it, right? So a trust should own your real estate, it should own businesses, and it should own your home. A trust does not need to own retirement accounts, bank accounts, life insurance, or your HSA. What you can do is make the trust the beneficiary, right, of those proceeds on those respective accounts. And that's an important nuance I want everybody to understand. Now, there are some advanced trust strategies that relative to your situation could make sense. I'm not going to go in depth. I just want you guys to have awareness because typically you might only hear people talk about revocable or irrevocable. So I want you guys to have awareness so that as you're going down this process, you can say, well, after understanding more about it, this potentially could make sense for me, right? So first one is a grantor retained annuity trust, GRAT for short. Allows you to freeze asset values while transferring appreciation out of the estate. Okay? Intentionally defective. I don't know who decided to name these things, which is why they have the acronyms, because these names are not catchy at all. Intentionally defective grantor trusts, right? This is when you sell assets to trust for future appreciation shift, right? So you're selling assets to the trust for future appreciation and you're shifting that to the trust, okay? Spousal Lifetime Access Trust, also known as a SLAT, provide access for a spouse while moving wealth out of the estate. Irrevocable Life Insurance Trust, also known as an ILIT, keep insurance proceeds estate tax free. Dynasty Trust, lock in multi-generational tax advantages and creditor protection, right? This is similar to what the Rockefeller family did. Charitable Remainder or Lead Trust, combine philanthropy with tax efficiency for the best of both worlds. Domestic versus offshore asset protection trust, right? Comparative advantages in risk mitigation when shifting assets offshore who have different levels of protection and laws that could be applicable. Now, again, you will know which route is best for you when you understand the depths of your current strategy. And keep in mind that your estate plan can evolve as you evolve. So for probably 95% of the people in this room, living revocable trust is going to suit you just fine, right? But if your situation advances, or if you're going to have an exit of a multi-million dollar business or a variety of other reasons, there could be scenarios where looking at your estate plan in a more advanced way could make sense. But for the vast majority of people in this room, a living revocable trust will likely get the job done. Okay. Now let's think about business and family enterprise planning. So using trust for business succession and voting or non-voting share transfers, right? Because if you have a business, you want to make sure that you're factoring in succession planning as a part of your estate planning, right? Because unless you want your business to die with you, then we got to factor that in as a part of the estate planning process. Family limited partnerships and LLCs for valuation discounts. Buy-sell agreements funded through life insurance inside of trust. So for example, me and Carter own our business, right? 50-50. I have family members, he has family members, and we love those family members. If something happens to either one of us, right, naturally somebody on our side is going to inherit our ownership interest in the business. However, we don't necessarily want that person to try to step in and run the business, right? I love my sister to death. Well, actually, my sister, she's pretty good. She probably could help out. But I love my mom to death, but I don't know if she is the best person to run a wealth management tax advisory firm, right? So a buy-sell agreement funded through life insurance happens where you value your business. I would recommend having the type of life insurance that is permanent, that can allow you, that you can renew over time. And ultimately, you have enough life insurance to cover what the buyout proceeds would be for the other owner. So that instead of transferring the ownership interest to that family member who would technically have the right to potentially come in and help you run the business, you're saying, hey, here's a check for 50% of what the business is worth, or the business interest, and now they can get that, and then you own the business outright, not because you don't want them to inherit it, but because they're not suited to run the business. Now, if I'm grooming my son Legend, right, to be the successor, and he's old enough to do what I do, maybe in that scenario, maybe that could work. But generally speaking, especially if it's a premature, unexpected death, you want to make sure that you don't have key man risk, and that you have the ability for the business to still go on through buy-sell agreements if there are partners. Okay. Multi-generational business governance through dynasty or perpetual trust, right? And again, that's just a fancy way of saying that you want to make sure that there's been a process in place where your business has thoroughly documented, right, what the business is supposed to look like for generations to come. And ultimately, the structure and ownership of that is protected through the trust structure. Keeping your estate plan current, right? Update your plan to reflect life changes like marriage, children, and or new assets. Very simple, right? So I recommend every year having a family meeting where you're reviewing, were there any significant life changes that would reflect us making changes to our estate plan? And even before you have an estate plan, like, are your beneficiaries up to date? These are things that we want to keep up to date, because these aren't things you want to think about when you have to think about them, right? If you wait till it's raining to reach for the umbrella, it's already too late. And of course, regular reviews ensures ongoing relevance and effectiveness, because also you got to factor in, have tax laws change, have estate tax laws change, anything that could potentially impact the way that your current estate plan is set up. You want to make sure that you've addressed that and refreshed that accordingly. Okay. Now, I want to reiterate, the purpose of this is not to be overly complicated. The purpose of this is to say, you know what? I've built some level of wealth over my lifetime. And here's the thing, for everybody wondering if an estate plan is for you. If you have a life insurance policy, right? Even if you have zero assets, you definitely should have an estate plan, right? And because you can have $1 million legacy for pennies on the dollar, depending upon the type of insurance that you get. And you want to make sure that whatever you did to set your family up for success, that is protected, and that is going to be allocated and distributed in a way that's going to benefit your family for years to come. Okay? All right, so that is the high-level overview of Estate Planning Basics 101. And we will, well, before we get out of here, hopefully that made sense, guys. We're gonna let you guys come off mute again here in a second, so you guys can get the energy as we leave the room and get prepared for day three of the wealth workshop. But team, if you can let everybody off mute, and we'll close out the room on a high energy note and also give them any words.
Oh, let's go.
Amazing.
Hey,
Amazing class.
yes.
Friends,
Amazing.
That's good
Amazing.
information.
So wonderful.
Good work.
Good work. Good work.
Amazing.
Thank you so much.
Thank you.
Woo.
Information. Thank you.
Good job. Thank you.
Amazing. Thank you. Great information.
This
money.
You guys are awesome.
I thought we had so many people excited about learning about financial literacy, man. This is
crazy work.
Crazy work. Okay, guys. So here's the thing. Homework, as always, homework. Doris has an amazing video that y'all are going to probably watch multiple times tonight. That is, so one of the homeworks is watch this YouTube video. And then the second piece of homework is based on the strategies that we gave today and the strategies in the YouTube video. What are two things that you're going to do before the end of the year to set up either your kids or your grandkids in a better financial position, right? So we talked about paying your children today. We talked about trust structures today. George's YouTube video talks about more things that you can do to put your children in a better position. So watch the video number one, and number two, what strategies you're going to implement before the end of the year, or at least start before the end of the year, to put either your children or your grandchildren in a better financial position. Okay, so team, can we redrop the link to school if people don't have it? And we will close out tonight, and then we'll see you all bright and early tomorrow at the same time. Team, are we good to go, France? There's a link in the chat. The homework we place in school.
Yep.
Cool. Cool. All right, guys. See y'all tomorrow for day 3. See y'all tomorrow for day 3. Peace out.
Peace.